This week on Wealth Track, who will win the tug of war between the forces of stimulus and austerity, inflation and deflation? Financial thought leader John Brynjolfsson and great investor Robert Kessler take sides in one of the great financial battles of our time. Next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of the great financial debates of our time is between the forces of inflation and deflation. Is the U.S. entering a Japan-like period of painfully slow growth and falling prices, or simply recovering in spurts from a devastating financial crisis? Well, this is not just an academic exercise. The outcome of whether prices are rising, stagnating, or falling will determine everything from interest rate policy by the Federal Reserve to the value of our homes and salaries, to Social Security and Medicare payments, to our investment strategy. And it is the last that we are focusing on in this week's Wealth Track. No one, including the Fed, disputes the fact that inflation is rising. As this chart from Strategas Research Partners shows, both the CPI, or Consumer Price Index, in blue and the red core CPI, which excludes the more volatile food and energy prices, are accelerating. And core inflation is in the upper end of what the Federal Reserve deems acceptable. On the other hand, the forces of disinflation and even deflation are exerting their own pull. In an economy dependent upon consumer spending for 70% plus of its growth, unemployment is still uncomfortably high. For those who are working, wages and salaries are flat and not even keeping up with modest inflation. And companies, both large and small, remain reluctant to hire. What should you plan for in the months ahead? Do you tailor your investment strategy for inflation, disinflation, or even deflation? Well, joining us are two investment pros with strong opinions and strategies to go with them. John Brynjolfsson is founder and chief investment officer of Armored Wolf, a global macro hedge fund seeking to profit from imbalances created by global inflation and deflation. He is a pioneer in real return investing designed to outperform inflation and preserve purchasing power. He launched the first real return mutual funds at PIMCO. Robert Kessler is the CEO of Kessler Investment Advisors, a global manager of portfolios of U.S. Treasury securities and other government debt for institutions and governments. Fortune magazine has called Kessler one of America's top investors. I began the interview by asking them where they stood on the inflation debate.
Right now, inflation is actually pretty contained because you've got housing under pressure and relatively contained. You've got food and energy prices essentially off the charts, but the average of the two, with housing being 40% of CPI, inflation is contained. But more importantly, the Fed realizes that. The Fed is trying to get the core CPI up towards 2%, and my suspicion is that they'll be overshooting that target, and in the meantime creating more and more inflation in the energy, the commodities, and the global markets.
So the pressures are building, but short-term inflation is contained in the U.S.
Very short-term inflation is below target, and that's really the danger signal, because the liquidity that's being produced by the Fed right now is historic in nature. There's more liquidity being produced right now than there was during the depths of the crisis in 2008.
And that will lead to inflation. They're printing money, in other words.
They are.
All right. Robert Kessler, so inflation, where do you come out in the inflation, disinflation, deflation debate?
I think I'd take a longer viewpoint on inflation right now, and that's probably because wages are not increasing, and the basis to inflation really are wages. And when you have 20 million some odd people either underemployed or unemployed in this country, and probably all the problems that are taking place in Europe, problems that are taking place in China in terms of excess capacity, it's very difficult to end up with inflation. So bottom line here is probably the Fed is right. They don't see any foreseeable future, and it probably would be presumptuous of me to actually name a date. Oh, in 3 years or 4 years or 5 years, I think we'll see inflation. I think it's going to be years and years and years before we really see any inflation at all.
So what about the argument that John just made, is that the fact that we've had so much stimulus from the federal government, deficit spending, that in fact that traditionally has been very inflationary?
What's intriguing about this period of time is that the government spending is going to the credit side, not the kind of the debit side. That's you and I. We're the ones in debt. And in bailing out the banks, all of this excess money, the $600 billion that we just kind of created, is sitting in kind of reserves. It's sitting in the banks. It's not going into the economy. Mm-hmm. So if it doesn't go into the economy and we don't have what we call velocity, we don't have any movement of the money, and it doesn't go to me, and we don't get jobs, and we're all on food stamps in the same way we were, then the deleveraging process, this paying down debt, is just going to take an awful long time, especially coming into June, July, as we are with a Congress that's going to be rather austere as opposed to coming in with stimulus. So it's a difficult period of time.
So John, how do you figure that in? I mean, isn't this time different in that we've had this unprecedented credit bubble, 30 years in the making, and now we have this deleveraging that we've just had it unwinding for 3 years. So I mean, couldn't this time be different? And in fact, what you're seeing the Fed do and the government do and the deficit spending as well, that this is not going to turn out to be as inflationary as it would have under normal circumstances? So
there's a couple different things going on here.
Right.
One is growth and healthy real productivity is different from inflation. And there's no doubt that there's a lot of deadwood out there in the economy. Foreclosures sitting on the housing market, unemployed sitting on the services and wage markets. About 2 years ago, we were at a point where you had this pushing on a string concept, which Keynes talks about and others talked about. We were close to a zero bound on interest rates, meaning that you couldn't lower interest rates below zero. And if we were deflating, Bernanke was afraid that would be a spiral like we had in the 30s. Bernanke was very aggressive with QE1. QE2 was kind of an insurance policy. We're now running at a 3.6% headline inflation rate, 1.6% core rate of inflation. Those rates actually give you a pretty high cushion above the 0% Fed funds rate. So we're running at a negative real interest rate, negative 2%, negative 3%, maybe negative 3.6% based off of headline. That is an extremely low. It's a negative real interest rate, which is almost unprecedented. So while there were some concerns 24 months ago about pushing on a string, we now have inflationary dynamics that have started. And as long as the Fed stays at zero, this inflationary dynamic will accelerate, and we see it in the food and energy prices. We see it in the emerging markets. And the U.S. is not isolated. So we can have weak U.S. housing and weak U.S. employment at the same time as the dollar is depreciating and inflation is percolating throughout the economy.
So, and the fact that the purchasing power of the dollar is decreasing, which is inflationary, considering how much of our we import, for goods and services in this country. So, I want to talk to you each about the imbalances that you're seeing and how you're managing them. And John, at Armored Wolf, you seek to profit from macro imbalances created by global inflation and deflation. So what kinds of imbalances are you seeing in the economy right now, and how are you seeking to profit from them?
Sure. So we try to be nimble, and we certainly allow for the possibility of deflation, and on a macro basis, that was certainly the case 2 or 3 years ago.
Right.
Right now, we look at the deflationary side of that equation much more narrowly in certain sectors, like the housing sector. The balance on the inflationary side is much stronger. We see emerging market countries sucking in capital from the printing presses that the Fed, the ECB, Bank of Japan, and other major developed countries' central banks are printing. And people are looking for an alternative reserve currency other than the dollar. The euro obviously is not a candidate. The yen is not a candidate. And you end up with either emerging market currencies like the RMB or gold and other precious metals as a metric of fundamental value as opposed to something as, let's say, flimsy as a paper dollar bill.
Yeah, let's talk about that, because this is where, Robert Kessler is a contrarian in this particular area. And for as long as I've known you, which has been about 6 or 7 years, you have been a proponent of the fact that treasuries are still, that the dollar is still the reserve currency and there ain't no substitute readily available. And number two is that U.S. treasuries are still a store of value, safety, and liquidity. So let's talk about the imbalances that John's talking about and how that affects your view of treasury still and the dollar.
Let me bring up an article that was in the newspaper today, so I can talk about something very current. There's an article about China, and since I spend a lot of time in China, this is about a city called Wuhan in China. And the discussion really is how much money is being spent in that city and in every city on infrastructure. And in fact, infrastructure spending in China has reached almost 70% of their GDP, 70%. To put that into some kind of perspective, when Japan kind of had its bubble burst, they had 35% of their money being put into infrastructure. So you have this tremendous amount of excess being built into China. That's what we call output gap over here. Excess capacity, excess factories. In fact, they say in Wuhan that it'll take 8 years to fill up the space, and they're still building as fast as they were building before. So you have a world now in China and in the peripheral countries in Europe with all of this excess, and that output gap that we talk about is going to be with us in a deleveraging process for many, many years. So when we talk about where are things going to go, let me bring up one point.
So that's a huge imbalance, as you're saying.
A tremendous imbalance, but
excess capacity, certainly in infrastructure.
If I can talk about something having to do with the Treasury market, which is interesting. Most people like to say Treasuries have averaged something like 7%, and they're very cheap at the moment, or expensive, being 3% roughly. The fact of the matter is they always compare this to the last 40 years. What we should do is look at the prior 40 years.
And you're talking about the yield on Treasuries.
In the yield on the Treasuries.
Right.
And from the 1930s into the 1970s, a 40-year period of time, the average was 3%. And that's because we were coming out of what we call an imbalanced credit bubble, whatever you want to call it, the depression, but very similar to what we have today. And it took years and years and years to finally get through that deleveraging process. And in fact, as we mentioned when we were talking together, the Treasury hit its low 15 years after the Depression started, which was 1.5%. So if we're going to make a comparison, we should look at balance sheet recessions like Japan, which has taken 20 years, and our own balance sheet recession, which has taken 15 years. And we're in our third year. So we have some time to look at this process, and it's not a very pleasant period of time.
So as a result, you're saying that Treasury yields not only could stay where they are for an extended period of time, sorry to use the Fed speak, but I mean, you're talking years, indefinite period of time. But in fact, they could go lower as this deleveraging occurs. It sounds like a rolling deleveraging scenario. It's happening here now, and it could be happening in China, let's say in 5 or 10 years. So
the average in these balance sheet recessions that we look at, average recession period of time isn't 5 or 7 years. It's 2.5, 3 years. So you could have a recession in 2012. That wouldn't be out of the question in the way we're slowing down now, and with an austere Congress and an austere, I mean, Europe just raised their rates, which is something we were doing in terms of austerity in 1936. So I'm not making these comparisons lightly. What I'm trying to say is that there is a very serious market out there in terms of being conservative. And conservative means that you don't take risk. So John specializes in areas that he understands in terms of where to take risk.
Right, alternative investments.
And those are all and they're very, very good areas. From my personal viewpoint, I end up looking at cash or treasuries because I have a long history to say this is what they're going to do, this is what they've done in the past.
You know, John, the argument is, and you know that just about every professional on Wall Street thinks that treasuries are worthless, you're going to lose money, and that they are actually at very high risk, and that the dollar is going to continue to depreciate and go south. That's the consensus, which always should make you very nervous that everyone feels that way. So what's your feeling about, you know, treasuries and the role that they should play in investors' portfolios and also dollar-denominated assets?
I think it's very instructive to look at the Depression in the 1930s,
right,
to look at Japan and ask about what the monetary policy was during those periods. And I don't know that we've learned a lot in whatever 1,000 years since paper money was invented in China, but generally what happens with paper currencies is eventually they devalue and become worthless. In the case of the 30s, we had very high real interest rates. We had deflation, and the Fed actually tightened interest rates. So you had a deflationary dynamic. Ultimately, World War II helped pull us out of that. Things changed. In Japan, you have a relatively tight monetary policy. The yen is very strong. It used to be at 160 to 170 to the dollar. Then it went through 100. Now it's at about 80 to the dollar, which means a very strong yen. So you have a deflationary type of monetary policy being run in Japan, where the interest rates on cash in Japan is higher than the inflation rate at the same time that they're trying to face these demographic headwinds. In the U.S., we don't have that situation. We have Ben Bernanke, who's a student of all of these episodes, who believes he can target inflation at 2%. I think, and I have no doubt that he has the tools to do that. He's said so himself. He's got a printing press in the basement of the Fed, and as long as he's got paper and ink and the press, he can print as much money as he wants. That's a fact. So the real question is, will he achieve his target right on the bullseye, or will he overshoot it? With unemployment at 9%, the tendency is that he's going to have political pressure to overshoot. As long as both inflation is below his target and unemployment is above the target, those both prescribe more money printing, and that's what he's doing. We have the lowest real interest rates that I've seen in 50 years. I've rarely seen real interest rates below zero. Even a year ago, they were only -2. Now they're -3.6.
And the significance of that is, for the layperson, why should that be kind of shocking to me, or what are the implications for that from an investment point of view?
Well, what it means is more and more liquidity is pumping into the system, and Bernanke's reaction function is going to largely be based on homeowners equivalent rent and actual rents, because that's 40% of the CPI. We're now seeing actual rent prices starting to accelerate.
Right, we're seeing rent inflation, in fact.
Exactly.
Right.
So we got the weakest component of the CPI now starting to creep upwards. I don't know if I want to say that I hope he tightens when we get to 2%, because that could be pretty painful, especially for big risk takers in the markets. I don't think of a 30-year Treasury as a low-risk way to lock in purchasing power. I think of that as a low-risk way of locking in paper currency, and we don't know what that paper currency will buy 30 years from now. So in fact, it's extremely risky.
One of the difficulties about this whole process that we're in is this concept of printing money. It's something I don't understand, and I've never understood. Ben Bernanke is going to drop it from helicopters, and we're all going to pick up this money and go spend it. I myself personally have not seen any of this money. Money coming from the banks or the banking system, believe me, it's not out there. I happen to come from Denver, and I don't know what's going on in New York, but believe me, there's no money out there. So all of this idea that 0% interest rates have any meaning whatsoever to the average person is silly. The average person has to go to the bank and say, can I have money, or can I get a mortgage? And what we have to do, different than the banks, which is really interesting, us as homeowners have to go out and get what we call an appraisal. And that's something that we call mark to market. You have to get the market price. The banks don't exactly have to do that. They actually, because of some shenanigans, they ended up able to go get kind of 100 cents on the dollar. So if we were allowed to do book value on our houses, we could probably have a moratorium and go out and get all the mortgages we want at 2%. But we don't get 2%. And I'm not sure exactly when we say that 3% from a Treasury is a bad deal. It's a hell of a lot better than losing 30% in the stock market. And the stock market since 1998 hasn't gone anyplace.
At least the S&P 500 haven't.
Well, the S&P 500. I'm not smart enough to always know what the right place is. And from what I can see, the correlation in a lot of hedge funds and a lot of other places is they don't either. So it's a tough market to play in. An interesting thing about Treasuries, Treasuries generally, when we talk about a 30-year Treasury at 3% or 4%, 4.5%, we think of it as 30 years. It's no different than a stock. A stock has a perpetual life to it. A stock is forever. A Treasury at least tells you it's 5 years, 10 years, or 30 years. So you don't have to hold it for 30 years and you don't have to hold it for 5. Now, if you believe me that Treasuries are going to go down to 1.5%, then
the 10-year you're talking
the
about.
10-year
right.
Treasury, then someplace in the near future, assuming it's not 10 years, you'll either have gotten 3% plus on your money while you waited, or you'll be making 9, 10, 11%. That's not a bad deal, considering we haven't done so well in the other choices.
So consider as an investor, rather than think I'm buying a 30-year Treasury and I've got to hold it for 30 years and the value of it's going to depreciate, is think of it as you would a stock that, gee, I might trade it and go into yet another Treasury security.
Sure,
but the fact is it will be liquid. You will get money for it. And
let me make a very quick point.
Yeah.
Treasuries in the last 3 years, 5 years, 10 years, and 20 years have outperformed commodities and the S&P index.
Right, which is something that actually should disturb you, Robert Kessler, because there's something called reversion to the mean. But aside from that, points well taken about Treasuries and how we should view them more as a trading vehicle as opposed to just a buy and hold, possibly. But let me ask Brynjo, because I wanted, it's possible that we two can kind of meet in the middle, because Brynjo, as far as stores of value that are not all that liquid, I mean, we can't go to the store with our commodities basket and try to we can't barter yet. So what should we do with what kind of commodities do you think that we all should own some of in our portfolios? I mean, what are going to hold their stores of value?
Well, obviously mutual funds are a big part of the retail and the institutional marketplace.
Right. I mean, what kind of mutual funds? I'm talking about hard assets, for instance.
Yeah. So the mutual funds that I've created, and I created a big one at PIMCO, and
right, the
now
real
I'm creating
return
one.
funds, right?
What they do is they look at an index of commodities that are all transparently priced, that have futures contracts traded on. They create these indexes essentially on a market cap basis by saying how much volume of each commodity gets produced and what is the price of that commodity, and let's put that weight into the index. Now, they don't want to do every single commodity in the world. There's 300 different commodities, but there are 19 highly liquid global commodities. You'd have your crude oil, your gasoline, your Brent, your heating oil. You'd have your grains, you'd have your metals. And the 19 largest blocks of commodities in the world are published as an index by Dow Jones UBS.
Right. So you can buy a mutual fund, a broadly diversified mutual fund that is invested in commodities. That is one way that we could invest.
That's the way to do it, because by investing in a commodity index, you're getting broad exposure to all commodities. You're not making calls on individual commodities. And you're keeping your cash in a highly liquid form. You can put it in TIPS, which is what they do over at the PIMCO fund by and large. You can put it into other alternative strategies, which is what we do with Eaton Vance. But that's right. I think, a great way to get exposure to commodity markets.
So let's split the difference. We believe in broadly diversified portfolios here. So I know there's a place for Treasuries in our portfolios, and there certainly is a place for commodities as well. And we're going to have to leave it there. So Robert Kessler from Kessler Investment Advisors, thank you so much for joining us. And John Brynjolfsson, formerly at PIMCO, but now at your own hedge fund, Armored Wolf. Thank you very much for joining us on WealthTrack.
Thank you.
And that is a wrap for this edition of WealthTrack. I hope you can join us next week. I'm going to sit down with two top global strategists. Fort Washington Advisors Nick Sargent will tell us why he thinks global markets are at a crossroads. And New York Life's John Kim will discuss how he is changing the way New York Life manages investment risk. Until then, to watch this program again, please go to our website, wealthtrack.com, to see it as a podcast or streaming video. Thank you for taking the time to visit with us. Have a great weekend and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.